When you hear the name Warren Buffett, many immediately think of wealth, the stock market, and his remarkable investment foresight. But Buffett's success didn't happen overnight. His childhood and early life laid the groundwork for the achievements he would later realize. Buffett was born in Omaha, Nebraska, in the American Midwest, a place you might not be too familiar with, but it's become a holy site for investors worldwide thanks to Buffett. His father, Howard Buffett, was a stockbroker, and his mother was a cheerful yet strict homemaker. You could say Buffett grew up in a household steeped in business. Even as a little boy, Buffett showed an extraordinary interest in numbers. By the age of 5, he had already learned how to make money through small ventures. While other kids were playing, Buffett was setting up a little stand outside his house, selling chewing gum to passers-by. Although it might seem insignificant, this tiny business venture revealed Buffett's innate business acumen. Imagine a 5-year-old who understands how to use the resources around him to make money. It's almost unbelievable. By the time he was 9, Buffett's business instincts had become more apparent. He and his friend Bob Russell would go to gas stations to count the bottle caps that fell out of the vending machines. It might sound like a child's game, but in fact, Buffett was training his sensitivity to numbers and his powers of observation. This obsession with numbers and money accompanied him throughout his childhood and would become the foundation of his future success. Though the Buffett family was well off, his parents were strict in their upbringing. His father, Howard, played a particularly important role in Buffett's development. As a stockbroker, Howard Buffett knew the unpredictable risks of the investment world, so he instilled in Warren the importance of careful financial management from an early age. It's safe to say that Buffett learned much about stocks and bonds from his father, which was his first introduction to the world of investing. Buffett's business talent became increasingly apparent during his teenage years. At 13, he started delivering newspapers and filed his first tax return at the end of the year. To put this in perspective, this was the 1940s, and for a 13-year-old to understand the concept of filing taxes was practically unheard of. He was a prodigy. But delivering newspapers wasn't just about pocket money for Buffett. He quickly realized that if he wanted to grow his newspaper business, he needed to manage his time and resources efficiently. So, he began thinking about the best routes to deliver papers, how to expand his reach, and how to maintain good relationships with his customers. Through delivering newspapers, Buffett not only learned the basics of business, but also honed his management skills and patience. In addition to delivering papers, Buffett dabbled in other small businesses. He would collect stray golf balls from a local golf course and sell them to players who didn't want to pay full price for new ones. These small ventures, though seemingly trivial, helped Buffett accumulate his initial wealth. More importantly, they taught him the value of capital accumulation. Buffett's business sense wasn't just about making money, it also reflected in his attitude toward money. At the age of 7, he was hospitalized with a severe fever and had his appendix removed. Though he was frail and doctors feared for his life, Buffett didn't wallow in despair. Instead, he picked up a pencil and started jotting down numbers on a piece of paper. When a nurse asked what the numbers represented, he replied, "That's my future wealth." From that moment, Buffett's money game officially began. Buffett's interest in stocks stemmed from his father's influence. Howard Buffett was a stockbroker who often brought home rolls of ticker tape from the stock market. Warren would spread these tapes out on the floor, trying to make sense of the intricate numbers. Imagine a little boy sitting on the floor, poring over those dense digits. It's like something out of a movie. And this early stock education laid the groundwork for Buffett's future investment career. In school, Buffett wasn't particularly outgoing. He was a good student, but very introverted, and didn't enjoy much social interaction. Despite this, his obsession with numbers and money set him apart. He often kept to himself, lost in his thoughts. His classmates probably couldn't understand why this boy was so fixated on stocks and bonds, but in time, the answer would become clear. Buffett's investment savvy wasn't limited to stocks. He also gained experience from various small businesses. Besides delivering newspapers and selling golf balls, he invested in an old pinball machine, placing it in a barbershop and collecting the profits weekly with a friend. These small ventures, though modest in scale, taught Buffett how to manage investments and assess risks and rewards. Buffett's academic journey wasn't entirely smooth. While attending the Wharton School at the University of Pennsylvania, he grew increasingly frustrated with the coursework. He felt it was too theoretical and had no practical value, especially for someone who had already been in the trenches of investing for years. So he decided to transfer to the University of Nebraska, where he completed his degree in just 3 years. Meanwhile, Buffett didn't let up on his investment activities. He continued delivering newspapers, running his pinball business, and seriously studying the stock market. By the time he'd saved over $5,000, he had also developed a unique investment philosophy through trial and error. For Buffett, college wasn't so much an academic finish line as it was the starting point of his investment journey. During this time, Buffett's investment ideas began to take shape. He realized that the stock market wasn't merely a numbers game, it was a world driven by complex human emotions. Factors like market sentiment, psychology, and expectations all had a significant impact on stock prices. Buffett understood that investing wasn't just about analyzing numbers. It was about understanding human nature, market emotions, and the intrinsic value of companies. The most important mentor in Buffett's investment career was undoubtedly Benjamin Graham. Graham was the father of value investing, a philosophy that has influenced countless investors, with Buffett being the most successful of them all. And Buffett first encountered Graham's ideas through his classic book, The Intelligent Investor. The value investing principles in the book completely changed the way Buffett viewed the stock market. Before reading Graham, Buffett had experimented with various speculative methods, studied stock charts, and even tried to profit from insider information. But Graham's theories made Buffett realize that stock investing wasn't gambling. Instead, it was about making careful, analytical decisions and holding on to investments for the long term to see the company's intrinsic value grow. Buffett's admiration for Graham wasn't just theoretical. He pursued it practically by enrolling at Columbia University to study under Graham directly. In the classroom, Buffett soaked up Graham's wisdom like a sponge, and the two developed a deep mentor-mentee relationship. Graham taught Buffett how to evaluate a stock's intrinsic value through quantitative analysis, and he firmly believed that the market was irrational. Prices often fell below actual value, and this discrepancy was where smart investors could find opportunities. Graham's concept of a moat also left a lasting impression on Buffett, who began to understand that investing wasn't just about finding cheap stocks. It was about identifying companies with long-term competitive advantages. Under Graham's tutelage, Buffett quickly made a name for himself in the investment world. He joined Graham's firm, Graham Newman, and achieved remarkable success within a year. In 1954, Buffett identified a company called Rockwood Chocolate, which announced that it would repurchase some of its shares using its cocoa bean inventory. Buffett realized that by leveraging the price fluctuations of cocoa beans, he could make a significant profit. This insight made Buffett stand out within the company. However, despite his success at Graham Newman, Buffett always had a dream of striking out on his own. In 1956, he left Graham's firm and returned to Omaha to start his own partnership. This time, he wasn't working for someone else. He was his own boss. Buffett's partnership started with just $105,000, but through his exceptional investment acumen, he quickly multiplied the firm's assets. By 1962, Buffett's personal wealth had reached $1 million, and the partnership's total assets had grown to $7.2 million. During this period, Buffett's investment strategy began to take shape. He refused to disclose his stock portfolio because he didn't want others to imitate his moves and drive up stock prices. Taking control of Berkshire Hathaway marked a major turning point in Buffett's investment career. Berkshire Hathaway was originally a struggling textile company. In 1962, Buffett's partnership began buying shares of Berkshire Hathaway because he noticed that, despite the company's poor performance, its per-share operating capital was worth $16.50, while the stock price was only $8. Buffett saw this as an incredible investment opportunity, a stock trading far below the company's actual value. He continued buying shares of Berkshire Hathaway until he became its largest shareholder. In 1965, Buffett officially took control of the company and began a comprehensive overhaul. Buffett's management strategy was simple. He focused on return on investment, ROI, rather than the company's size. He encouraged management to run the company boldly, without being constrained by quarterly expectations, focusing instead on long-term returns. Under this philosophy, Berkshire Hathaway gradually grew into a giant company with a market value in the billions. As time passed, Buffett's investment philosophy matured. He didn't just focus on stock numbers, he cared deeply about the quality of the businesses he invested in. When looking at a stock, he no longer saw just numbers on a balance sheet, but a company with unique potential and momentum. Buffett's investment philosophy can be summed up in one phrase: only buy what you understand. He believed that investors must have a deep understanding of the businesses they invest in. Only then can they make informed decisions. This philosophy helped him avoid many common investor mistakes, such as blindly following trends or chasing short-term profits. Buffett's investment in American Express has become a legendary case study in the world of investing. In the 1960s, American Express was hit by a major scandal known as the Salad Oil Scandal, which severely damaged the company's reputation. Many investors panicked and sold off their shares, causing the stock price to plummet. But Buffett wasn't swayed by the market's fear. Through his research, he discovered that despite the scandal, American Express's brand remained strong, and consumers were still using its credit cards and travelers' checks. Buffett believed that the company had a strong moat and that its brand power would help it recover. So Buffett boldly decided to buy into American Express. He invested a quarter of his firm's assets into the company. If his judgment had been wrong, not only would his wealth have evaporated, but his reputation would have taken a serious hit. However, Buffett's conviction paid off. American Express weathered the crisis, its stock price rebounded, and Buffett reaped massive profits. Despite Buffett's soaring success in the investment world, his family life wasn't always smooth. His wife, Susan, who had a deep passion for music, eventually left Omaha to pursue her singing career in San Francisco. Susan's departure had a profound impact on Buffett, but the two remained close and never divorced. After Susan left, Buffett developed a relationship with Astrid Menks, a kind and gentle woman who played a significant role in his life. Buffett once joked that he had two wives, Susan and Astrid. While this unconventional family dynamic might seem odd to outsiders, the three of them developed a harmonious relationship. Buffett's lifestyle remained remarkably simple. He didn't indulge in luxury, continuing to wear his signature grey-brown suits, enjoying steak dinners at home, and watching Nebraska Cornhuskers football games. His approach to life was incredibly modest, even though he was one of the wealthiest people in the world. Buffett's investment in Coca-Cola is another classic example from his career. In the fall of 1988, Buffett began buying up large amounts of Coca-Cola stock. Although the stock price had already fallen 25% from its peak, Buffett recognized the company's brand value and global market potential. Buffett's investment strategy was to find stocks that were trading far below their actual value, and Coca-Cola fit the bill perfectly. He believed that Coca-Cola had both a strong brand and a simple business model. It produced Coke concentrate and sold it to bottling plants around the world. This business model required little capital and yielded high profit margins. More importantly, Buffett saw that Coca-Cola had a strong moat. Globally, no other beverage company could seriously challenge Coca-Cola's market position. In international markets, Coca-Cola's sales were 4 times those of Pepsi. Buffett was confident that the company had enormous growth potential. As it turned out, Buffett's judgment was spot on. Coca-Cola's earnings per share rose 64%, and its stock price tripled in just a few years. Buffett's investment not only earned him a fortune, but also boosted Berkshire Hathaway's stock price. Despite his immense wealth, Buffett has always had a cautious attitude toward money. He believes that wealth should be used to benefit society, not for personal extravagance. Buffett has criticized the lavish lifestyles of some of the ultra-rich, arguing that their wealth could be put to much better use. Buffett was also rational in managing family relationships. He wanted his children to be financially independent, so he stopped giving them financial support. Initially, his children were unhappy with this decision, but over time, they came to understand and accept his approach. Buffett's philanthropic efforts have focused on population control and world peace. He believes that overpopulation could lead to a host of social problems, so he has committed himself to preventing future tragedies through various initiatives. Buffett faced several challenges during his investment career, one of the most notable being the illegal bidding scandal at Salomon Brothers. At the time, the company was facing a major crisis that threatened its reputation. Buffett was brought in as interim chairman and, through a series of reforms, helped the company navigate through the turmoil. This experience not only tested Buffett's management abilities, but also strengthened his investment principles. He knew that every decision in the market was critical, requiring calm and rational thinking. Looking back on Warren Buffett's life, it's clear that his success was no accident. His deep understanding of investing, his keen market insights, and his unwavering commitment to long-term value were all key factors in his extraordinary achievements.